Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. I'm joined with Doug Hagran. Hey, Doug.
How you doing, Kirk? I'm having a fun Monday. Yourself?
I'm doing great. As
How
you
was your
can tell by
Thanksgiving?
my attire, I just got back from putting up my backyard hockey rink. So, yeah, it was a wonderful Thanksgiving. We had we spent the day of Thanksgiving with the family, and my in-laws came, and it was kind of a quiet, nice, relaxing Thanksgiving, which much to the chagrin of everybody else, but maybe other people don't have that, but mine was quiet, which is great. And then the next day we did a turkey football game with the neighbor's yard, which I'm just thankful I didn't pull a Hemi, but I'm certainly not in peak shape. I think I did a diving catch and I'm still sore. So yeah, it was fun, but rough. And then pretty much put up the backyard hockey rink yesterday, put up the tarp today, and then I'm going to fill it tonight. And based on the weather of being in the teens, the 20s and teens all week, I'm hoping we can skate by next weekend. So I'm excited. How about you, Doug? How was your Thanksgiving?
Oh, well, it started with an excellent trip to the into the woods to go deer hunting. So hopefully I'm not offending any vegans on the show that might be listening to the show. But
Vegans don't watch the show, Doug.
Yeah, I didn't think so. But we had an excellent time in Wisconsin. It was very successful. The freezer is full. That was a great time with family. And then I came back and got to enjoy an example of what not to do coaching. And for all of anybody out there that might be watching right now, I just threw on my Ohio State hat. I grew up in Columbus, Ohio. I'm a diehard Ohio State Buckeye fan, and they laid the greatest egg in the history of the rivalry with Michigan this past weekend. So if you're a Michigan fan, you can be out there and feel free to silently gloat. You've earned it. Nobody can claim cheating. Nobody can claim excuses. Not this time, except for one. What not to do when you're coaching. Michigan had one thing, Kirk, one thing they don't do well. Or I'm sorry, that they do really well. They have three future NFL prospects on their defensive line. The one thing you can't do against Michigan is run the ball up the middle. Guess what Ohio State decided to do the entire time with future NFL receivers? Run the ball up the middle. It ended up 13-10. Never went to their playmakers, never tried to never tried to get creative. And the reason I'm saying this is I think it's pertinent is because I'm also wearing something else today. I'm also wearing my Minnesota Vikings attire because I got to console my bitterness on Sunday by going to watch the Vikings play the Arizona Cardinals. And the Vikings also looked putrid for most of the game until the fourth quarter when they decided to start attacking Carolina by going to their strengths and using their playmakers and doing what they do best. And I think on the last drive, the winning touchdown, I think they went to Jefferson, probably 5-6 passes in a row. I mean, they started to attack and use their playmakers. Something Ohio State couldn't figure out. The point of this is it's not that hard in life to be successful. To be successful is to identify your strengths, not overthink it, not try to prove something. I think Ohio State staff tried to prove they're tougher than they were and go down the middle. And I think that's the thing that I think it's a real good translation for, and comparison to life. Figure out what you're good at. If you're not good at something, don't do it. Find someone else who's better at it and adjust. And if things aren't working, find out why they're not working. Do something different, but take advantage of your strengths. Too many people in this world end up in careers, end up making financial decisions, end up doing a number of different things in their life that are counterintuitive to their strengths. And for what reason? To prove something, lack of self-awareness, I don't know what it is. It never works. If you all have strengths out there, figure out what they are and work into those strengths, and you're going to be wildly successful. It was a humiliating, embarrassing, just miserable friggin' start to the weekend. There you are.
Well, I can tell you're a little upset, Doug, but I can also attribute the fact that I almost never watch college football, but I actually happened to see that game. So I was pleasantly surprised to see Michigan plant that flag and then start a riot, which I thought was hilarious. I don't know if that was happening all weekend. I read some thing where people were like they were doing all weekend, but I thought it was a great game. I didn't see the whole thing, but I did see the last 2 minutes when Michigan won.
It was a great game that shouldn't have been a great game. They made it look like a great game of two solid teams. 3 yards in a cloud of dust used to be the old saying for Big Ten football going back decades ago. And congratulations, Ohio State. You figured out how to do 3 yards, literally, and a cloud of dust and a big fat L at the end of the game. First time they've lost 4 straight. Yeah, no, I'm not bitter at all.
Yeah,
But
was
no
was
excuses.
Michigan?
Hats off. Literally hats off as I just threw my hat. Hats off to
I'm
Michigan.
curious, Doug. Was Michigan ranked? Were they ranked this year?
Somewhere, but not in the listed top 25. This was the biggest loss.
Somewhere.
Ohio State had a 23 point, which favored by 23 points. It makes it the greatest loss. And I think the last time that Ohio State lost to Michigan when they were unranked was something like 1980. No, it might have been 92. But Ohio State was also not ranked that year. So for Ohio State to go in and be ranked, I mean, so Ohio State's lost 4 in a row. In 2020, I think 2021, Michigan was number 2. I might get this wrong. They were ranked in 22. They were ranked in 23. All 3 of those. Michigan was historic. They were ranked, and they ended up winning the national championship in 2023. This year, they lost everybody. Everybody. And no, they weren't ranked, making this the greatest loss in the history of the game. Congratulations, Ryan Day and Chip Kelly.
I just felt like rubbing that in because that's kind of mood I'm in, Doug.
Yeah, well, it's been fun. We turned this into a sports show. Everybody have a good weekend.
All right. Well, now to segue into some stuff that people actually want to hear, which is investing. So I did want to use your segue about working with your strengths because I think that's a good segue into something good, which is working within your strengths. I got a few bits I want to talk about today. So one of them is, I wasn't planning on talking about this, but why not? Work within your strengths. So one thing we used to talk about in the show a lot, and we haven't lately, is what I want to bring it up, is that most investors try to be somebody that they're not. They try to be Warren Buffett. They try to be like their favorite hedge fund manager. They're trying to be like David Einhorn. They're trying to be like Stan Druckenmiller, whoever they're trying to be like. The reality is you can't be like any of those people because you're not them. They are a special breed. And if you want to be like them, you have to be really, really good. You can't just be a fair weather fan. You can't just be a weekend hero. I'm going to go check the stock pages for a day and I'm going to be a hero. I'm going to read some course and be a hero. These guys, I just listened to an interview with Stan Druckenmiller last week, and he says he gets up at 4 a.m. to start investing. He goes to bed at 9 p.m. You got to get up real early to beat Stan Druckenmiller in the markets, okay? And here's a guy with lots of experience. So what I would advise everybody is this, working within your strengths. If you have the ability to be a good investor, then figure out what your investor psychology is. Now, what I mean by investor psychology is if you need action, if you're one of those gamblers who need action every second, you're betting on the football game, you're betting on the coin toss, you're betting on whether the guy's got his shoes tied, whatever you're betting on something because you need action. You should not invest like Warren Buffett. You are going to fail miserably. I don't care how smart you are. You're going to absolutely tank your portfolio because Warren Buffett's style is very deliberately staying away from Wall Street and all the hype and all the BS. And he's sitting there reading annual reports day in, day out and looking at stuff. Now, granted, his PR director is a genius because good old Warren, he's such a nice guy. No, he's not. He's a ruthless businessman. But he come across as this, good old Uncle Warren, nice guy kind of thing. He's got this great PR director. Anyway, point being is he is a special breed too, right? There's only one Warren Buffett. There are a lot of people, a lot of really smart people I know that try to be like him. You can't be like Warren. He's very different. Plus, Warren Buffett has something all these other guys don't have. He's got a property casualty insurance company, which we don't. Now, if you had one, you could have some success. Now, David Einhorn and I forget the other guy's name. 2 guys did this about 10 years ago. They bought PNC companies, so they thought they could get all the tax advantages of the PNC company. And they've also failed miserably because what they didn't realize, you have to be really good at underwriting. That's the secret. If you're good at underwriting and you're good with your investments, you're going to do wonderfully. But if you're not good at one of those things, you're just an average company. So point being is some people have a certain skill that matches their investor psychology. Now, if you need action and you're really good at psychologically managing yourself, because some people aren't in control of their emotions, right? They flip out, especially guys. You flip out because somebody pisses you off. They call you a name, and you're going to go pound your chest, punch them in the face. Like, you're not suited for some of this stuff, right? You have to be in control of your emotions. Now, you might be a good day trader if you're like a robot with your emotions. You're absolute control. It doesn't matter whether you make money or lose money. You're in control and you're following your system. Then you could be a really good day trader, and day traders can make really good money. And some of the people in the Market Wizards books, that I think it was Jack Schwager. Anyway, I am butchering his name. But anyway, he wrote a bunch of books called Market Wizards, and if I butcher the name, the guy's name's Jack. But anyway, Market Wizards, look them up. There's like 10 of them now, and they basically take these really successful investors that you probably never heard of, and they talk about what they're doing, why they're successful, and they interview them. It's great books. I highly recommend anybody who's looking to learn about investing read all of those books. Every single one of them is brilliant. Now, these people have gotten really good at understanding their own psychology and matching that with their skill set and really getting good at one thing. So if you're good at M&A or you're good at bankruptcies, I think it was Joel Greenblatt who wrote the little book of investing, or little book Investing that Beats the Market, or something like that. He was the first one to write the little book, and now everyone's writing the little book as a part of their books. Anyway, so he wrote this great book. And
John Bogle, The Little Book of Common Sense Investing. Yeah, so a lot of them have done it.
Yeah, there's a bunch of books. But so, and actually his book may not have been the little book, his really good book. Let's see. The Little Book That Beats the Markets. You Can Be a Stock Market Genius. That's the book I'm talking about. So I forgot about, I was mixing it up with his other book. So You Could Be a Stock Market Genius. He basically goes through all these different strategies, what people did, some really crazy stuff that most people aren't going to do, like bankruptcy. So you could, if you're really good and you understand bankruptcy law and you understand all the nuances and you're really good at it, you can go invest in these companies that are in bankruptcy and you could do really well. And some people have done extremely well, or mergers or splits, spinoffs. There's some great opportunities potentially in some of these things. And most people overlook them because they're like, I don't understand this stuff. But he was really good at it and made like 94% returns a year or some crazy number. So here's a guy who's doing things no one else is doing because he understands it and he knows how to get into the weeds. So whatever your strategy is, understand your own strengths. Don't play into other people's strengths, right? As Doug was saying, you could take a lesson from Ohio State. We could take a lot of lessons from them, but let's just take this one. Learn what your strengths are and what your weaknesses are, and don't play into your weaknesses. Play into your strengths. So if you're really terrible at sitting on your hands and letting a good investment run, then you probably shouldn't be investing like Warren Buffett. You should be a day trader. Whereas, if it's the reverse, then you figure out where your strength is. And maybe you have something that no one else is good at. Now, the other side of that is if you're really good at value investing and it's been out of favor for 20 years, well, good luck to you. Sorry to hear that, because most value investors have been out of favor, and I feel bad because a lot of them are really smart, and they do a great job, but they've been underperforming because value is underperforming. But it doesn't matter, because you're much better off doing what you do well and trying to focus on that and not trying to be somebody you're not. And like I said, take the lesson from Ohio State and do what you do well. And you know what? Frankly, if you're not good at high yield bonds and there's some great opportunities, I suspect in the next recession, there's going to be a tremendous opportunity in high yield bonds. There's also going to be a tremendous opportunity in value stocks and probably growth stocks at that point if we're in a massive recession. But if there's an area you're not good at, you don't have to learn it. Find a manager that's really good at it, invest with them. Find a financial advisor, find a fund manager, find a mutual fund, whatever it is, to fill the gap and use them for that piece. You don't have to be the expert. Just because someone else is doing it doesn't mean you have to go do it, right? If there's a really good high yield bond fund manager, and by the way, if you don't understand high yield bonds, never invest in them, use a fund manager. I understand them well enough, and I won't do them myself because there's so many reasons. But the point being is figure out what you're good at and be really good at that one thing, because you're going to reduce your risk significantly, and you're probably going to increase your upside significantly, and your risk to reward is going to be much better than everybody else. And you don't have to compare yourself to everybody else. Just make sure you do what you do well. And if you're comfortable with the returns, that's all that matters. Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today. All right, so there's one thing I saw this, and I wanted to share it because I thought it was interesting. I saw this come up, and it showed popular private companies and mutual funds. I wasn't even aware SpaceX was in a mutual fund, but apparently it is. So it looks like some of these private companies, ByteDance, SpaceX, Fanatics, Databricks, CoreWeave, Stripe. I thought Stripe was public. Epic Games, Canva. I thought Canva was public too, maybe not. Circle Internet, Redwood Materials. So it looks like these are the most popular private companies held in mutual funds. Now, I don't know about you, Doug, but I wasn't even aware you could have these private companies in mutual funds. And I didn't know if there was allotments anyway that they were giving out. So I don't know. Should people be investing in private companies? I mean, that looks pretty cool right there. I mean, here's a great return with and without SpaceX, according to these positions. I don't know. I find it interesting that people really want to get into private equity. But what are your thoughts, Doug? Should people be looking at these spaces?
Well, I mean, the one issue that's always been a reality of private equity is it's generally tends to be extremely expensive to invest into. It also tends to be something where liquidity becomes an issue. Now, if this is a mutual fund and that mutual fund is going to have the ability to create liquidity for the end user, for the retail investor, then it may be opening an opportunity for individuals to have an opportunity to finally get access to something that they typically have not had access to before, unless they were considered to be an accredited investor, with $250,000 in assets, or over on high income, or high income. And so, it's definitely, when you take a look at the number of public companies that are out there, it is extremely tiny compared to the number of private companies that are out there. The issue is, again, even for the mutual fund, my question would be, how liquid is the investments that are in it? I mean, how do you get a private stake in SpaceX? Are they making these mutual funds out of futures? Types of spreads, things like that. Because how do you mark that to market, and yet how do they get that access, and how do they then have the ability to change this portfolio up? I mean, so because they're obviously, the biggest thing about mutual funds, as you know, Kirk, and for those listening, is that mutual funds work on redemption. And that means that if I'm going to buy into a mutual fund, I'm giving my money into that mutual fund. That money is then going to go towards purchasing something, whether it's cash or assets. And then when I want out, they've got to redeem me. They've got to sell off shares to get it back to me. That's not something that you can easily do with private equity. So I'd have a lot of questions about this before I would be very, and of course, how do you get transparent information? They're private companies. They don't have to post regular quarterly statements. So I would definitely be very cautious before putting my money into one of these. But if, with further research and better understanding, again, it is always nice to start seeing that we are starting to see some disruption in areas that have typically had very high barriers of entry.
Yeah. Yeah, it's interesting. I know we don't talk about private equity very much, but I know it's been a trend for quite some time. Frankly, I'm not a big fan. I think it has its place, and for people who want something interesting because they want to like their investments, and if you have enough money where you don't care, I get it. There's some private equity investments that are investing in sports teams right now. There's some that are investing in all sorts of stuff, and it's really interesting. Now, liquidity has a very significant value because if you don't have liquidity, so let's just say the election happened and it was unclear as to who won and it was unclear for like 6 months. Like, let's just say that was a scenario. And that was my biggest fear, right? Is we didn't know I didn't care who won as long as somebody won, it was clear. And if Kamala had a landslide, which kind of hard to imagine, but if that happened, that would have been okay. I would have accepted it, moved on, and said, okay, like I don't like where this is going, but I know things are normal, like normal in air quotes, right? In normal field of normality. Trump won, okay, another field of normality. And so that's okay. But once you don't have it, it's just like it's all over the map. And so I think it's really important that I just lost my train of thought, Doug. I just was shaking my hands and just lost where I was going with that. What was I just talking about? All these.
You were talking about liquidity.
Oh, liquidity. Sorry. Yeah. Thanks, man. Sure. I spent all my energy making fun of Ohio State. Now I can't think straight.
Well, the problem is Kirk's making an ice rink out there, so liquidity is subjective at this moment.
That's a good one, Doug. Yeah, my brain's frozen too. Anyway, so liquidity. So I think it's really just important that let's just say you think there's a recession coming, you can't get out of it. You're just stuck. And what if we become Japan and you have a 30-year recession? Well, now your money is basically locked up or gone, depending on how the investment does. So it's a problem in many ways. So I'm not a big fan of illiquid investments, except for maybe your residence where you're living in, and it's not an investment in my standpoint. I think the rest, liquidity is really important. Now, if you have a small chunk where you don't care, I don't need it for 30 years. Okay, I get it. Like I'm not going to need that. If I lost it, it'd be okay. It's kind of like Bitcoin for me. Like I put a percentage of my net worth into Bitcoin like many years ago and just put it in and just left it. If it goes to zero, so be it. If it goes up to the moon, great. I'm happy, but I'm not losing sleep over it. Right. And granted, it is liquid, but I'm not treating it as
He's
liquid.
not losing any sleep over it right this moment.
No, I'm actually sleeping like a baby. Anyway. Yeah. So anyway, so liquidity is important, as Doug said, but I want to get into some other charts here that I think were important because we talk about, let's see if I can bring them up. Okay. So I want to get into this aspect of value investing because I think a lot of people overlook value for the sake of growth because growth is what's doing well, right? So I can't blame them. Look at how well growth's doing. It's it's in some of the top percentiles that we've ever had, and we'll get into this in another chart. But if you look at deep value, now I want to explain what value is versus deep value. And so there really is no agreed upon definition for value. The best way to describe value, some people say, well, value produces dividends and growth doesn't. Basically, what growth is a company that is focusing primarily on growing as fast as possible. They're not in the stagnant stage. They're not in the maintenance stage. They're in the growth or hyper growth, or they're focusing all their money on growing and less on maintaining. So if you look at tech companies, a lot of tech companies are focused on growth because they have to. Because if they stop growing, someone's going to eat their lunch, and then they'll be either acquired or they'll be out of the field completely. And their stock will be worthless. So they have to keep growing, right? Now, some companies like Apple, I think it was about 10 years ago, Apple went from growth to value. Now, when I say value, let me be clear. What value means is they have a different sense of growth. Now, Apple still grows well, but they started to focus on dividends. They started to focus more on shareholder yield, if you will. Microsoft started paying dividends and the same thing happened. They're still growing, and you could still put them in the growth category, but they're also in the value category. Now, I wouldn't call either one of them a value stock because they're not cheap. A value stock is typically a stock which is considered cheap in the relative universe. So, let's say the average PE of companies, I don't know what it is now. Let's say it's 30, for example. I don't know what it is today. Maybe Doug can pull this up. But let's say it's 30, right? Let's say the average PE is 30. That's really high historically. The lowest I think we've seen is maybe 8, P of 8. It was like 6 or 8. I think it was 8 in the 70s. That was a historically low PE, right? So if you have a PE of 7, go ahead, Doug.
I would say it's currently 27.87,
Okay.
and S&P 500 forward estimate is 23.98.
Okay. So let's call it 30 just to make the numbers easy. But so if it's 30, that's really expensive, right? And if the stock has a PE of 30 in comparison to everybody else, that's one metric. So if the average is 30, some are going to be more, some will be less. So the average is 30. But that's on a today's scale, but then you also have a scale of historical, right? So between 8 and let's say 35. I don't know what the highest was, but let's say 8 and 30.
Russell 2000 is currently at 35.96, and we have certainly talked about the challenges of the Russell 2. So,
Well, we'll get to them because they're interesting as well. But if you look at that, if you look at historically where the boundaries are, right, we're at the high end of the historical perspective, right, or the spectrum. So historically, we're more growth oriented or more expensive. Now, if you find a company that has an 8 PE, there's probably a reason for it right now, and you probably want to avoid it. But that would actually fall into the deep value category. Now, value is either you could look at it as relative or absolute, and I won't get too much in the weeds here, but basically relative value relative to everything else, or if you can think of it as maybe historical, right? So relative value to everything else. If everything else is 30 and you're at 20, okay, that's relative value right now, right? Or you could compare it to your industry. If you're a tobacco company, well, let's say there's 5 of them. How do you compare to other tobacco companies, right? Are you expensive or are you cheap? And so there's a lot of things you can compare it to, and when you're investing in stocks, you should. So if you're looking at, let's stick with tobacco, right? Let's say Philip Morris, let's say Altria. If you look at those two, how are they comparing to each other? Let's say the industry's 20. I don't know what it is, but let's say the industry's 20, and one's at 25 and one's at 15. Well, one of them's a value and one of them's maybe a little overvalued. So I'm not saying they don't deserve it. They might deserve it, which is what you have to analyze. But you should understand how they compare to each other. Then you should understand how they compare to the rest of the industry, like the rest of the S&P 500. And you should also understand how it compares historically within itself, also within the industry. So I'm giving you a lot of comparisons, but if you want to know if something's expensive or not, this is a good start. Now, there's a lot that goes into this fundamentally, and I'm skipping over that deliberately because we'd be here all day. But we're just talking about just a high level. I'm going to take a 10-minute look at a stock and determine whether it's good or not. Anyone could do this. Take you 5-10 minutes, and there's a few sites you can do this, and you can go and you can look historically. How does it compare? Is it cheaper, expensive to the industry? Is it cheaper, expensive to itself historically? Is it cheaper, expensive to the S&P? Is it cheaper, expensive to the industry historically? So you got all these different metrics, and you want to see like, oh wow, it's really cheap. Okay, now you start to do your homework. Why is it cheap, right? And you got to figure out if it's cheap for a reason. Because if it's a big stock, it's cheap for a reason. And Wall Street does not make too many mistakes on big stocks. It makes tons of mistakes on small or micro cap stocks because mainly they're too small and they don't play there. So there's a lot of room for error, and they can miss stuff. And you can find good deals. The big space, probably not. Mid cap, hit or miss, depending. There's fewer deals, but you can definitely find some. Small cap. There's a ton because the fund managers, there's a few of them, fewer dollars and all that. Now, deep value. Deep value is what, let's put it this way. It's great. Warren Buffett used to look at this, used to call them cigar butt stocks, which is basically looking at the book value and saying, well, I'm investing for the book value because it can't get any cheaper, kind of a thing, which is great, except for those companies don't grow, which is why he stopped doing that. So deep value, you can find great deals with low risk. However, you can also get caught in what they call a value trap. Now, a value trap is looking at something cheap and saying, oh, it's a great buy because it's cheap. Here's a good example. 2008, WAMU, Countrywide, and like 5 other stocks that were mortgage companies. If you look at the top holdings of mutual funds for like value and deep value managers, almost every single one of them were buying these things hand over fist as they went down. And you know what they were worth at the end? Zero, or close to zero. So you can get caught in a value trap. Just because something goes down doesn't mean it's a good buy. Sometimes it goes down for a reason and you should get out. This happened with a bunch of Chinese companies. Anyone who's invested there and gotten their hat handed to them knows I've had that happen. Um, but I think if you look at deep value, you have to be aware of the value trap. So things are cheap for a reason. You can look at there's very few cheap companies out there. And if you look, there's probably a good reason. It doesn't mean it's not going to turn around. It just means you have to understand the reason why and be comfortable with that reason. So if you're investing in let me give an example without naming the company, because I've done this a few times with this company. I don't want to name it. Let's say there's a company, it's in, I don't know, confectionery. Let me narrow it down. And let's say there's let's say the prices of cocoa are through the roof, as they are now. Okay. Now, are they going to be high forever? That's a good question. Maybe they will, maybe they won't. But let's assume for the moment they won't. If I'm assuming they won't, then, and the price has dropped of this company because cocoa has dropped, has gone through the roof. It's really expensive to produce this stuff, which means they're selling less, the earnings are impacted, yada, yada, yada. All that problem, right? Now, the problem is they're going to make less money. So the stock price should drop in accordance. Now, that will probably cause them to tighten up their costs. It'll probably cause them to cut expenses. It'll probably cause them to raise prices. It'll cause them to do a lot of things, okay, so that they don't lose money. Well, what's eventually going to happen? Eventually, the price of cocoa is going to come back down because in the short term, it's a problem that is a short-term problem, right? It's not like all of the cocoa plants have been destroyed for the next 10 years. That's not the problem, right? And so if you look at what the problem is and say, all right, is this fixable in a year, 2 years, and figure it out and determine, all right, is this going to be turned around? And you have to make a thesis on whether it is or not. If you think so, great, then you should invest. If you think it's not going to turn around, then don't invest, right? Just move on. But if you think there's some opportunity there, then that's a great opportunity to look at it and say, is this cheap? Is this a good company? Is it going to continue growing? Is this a short-term problem that's going to turn around? If it is a short-term problem that's going to turn around, great. Then now you can look at it as an opportunity to invest and wait, because value investing usually includes a lot of waiting, which for those of you who invest in growth stocks are probably going to hate this because you want action right away. You want to be going up all the time. You want to be in the front page of the paper. You know, when a stock is ignored, no one's talking about it, it's usually a good time to buy it. Kind of like Bitcoin. When no one's talking about Bitcoin because the price of Bitcoin is through the floor, it's a great time to pick some up because people have ignored it. And that happened about 2 years ago. No one was talking about it. It was at the end of the year, tax sauce selling, everyone was dumping it. I went and picked up a bunch. It was great. It was great timing. Now I've made some errors too. I'm not cherry picking the bottom, but I'm saying that was a great time. People were ignoring it. No one's talking about it. Bottomed out, end of the year tax selling. Side note, anyone who's looking to invest, look for year-end tax selling in the next month, because you're going to find some investments that people are just selling indiscriminately because they're like, I'm done with this thing. It's a piece of crap. They're done. That's a great time to buy if you think it's a good price where it is now, because it'll probably go down. And I have a few of those investments that I've got lined up and I'm just waiting for the end of the year to buy in. Every year you should look for that. It is a golden opportunity to pick stuff up. And you know what? In January, if it doesn't go up, then your thesis might be wrong and maybe you should unload it. But a lot of times what will happen is the end of the year tax loss selling, it'll turn back up and it'll start to go the other way. So I did a lot of talking, Doug, but I think people should be mindful of value investing. And we always say this because no one's talking about it. You should understand how to invest in value stocks because at some point that will turn. Who knows? If Trump's plan can turn things around, I think we probably won't see that for a while. But math is a hard thing to ignore. And I think, Trump's hardest problem right now is dealing with the math that, we have too much debt, deficits are too high, and we're kind of in a position where we're in a negative spiral where we can't really get out of unless they have massive growth in our economy. If we have massive growth in our economy, it is possible to get ourselves out of it. I just think it's highly unlikely. So I'm hopeful for what Trump's going to do, but I'm also suspect because I understand math and it's not impossible, but it's pretty close to fixing the problem that our country has. So, what do you think, Doug?
Well, I think this what's really interesting is right now is the market. I just saw that they're now looking at the odds of us going into a recession are now significantly down from where they were since November 1st. The odds of going into recession before 2026 fell from 53% to 38%. And markets are obviously no longer pricing in that is going to that's going to happen. And what's going back to what you just said about kind of what they're looking at tackling with regards to the new presidency is all they're talking about is cutting cost, right? And cutting cost, squeezing liquidity, making it so that things start to get reined in. Well, here's the issue with that. Yes, they are talking about, and again, whether they actually execute on any of this stuff will remain to be seen. A lot of it is still, until it happens, it's rhetoric, it's talking points. You got to get in there, take over, and they got to look through what they're going to do. But you start, we saw this a little bit, with kind of, let's just use Argentina as a great example. I mean, the original cost cutting threw their economy into a tailspin. Now, they have eventually recovered out of that in a way that they are, at least for now, seemingly much healthier and looking at inflation in ways that represent the traditional inflation we have had versus the hundreds of percent inflation that Argentinians have been used to. But I find this kind of ironic because what we're seeing right now is that all of the talk of cutting these costs is, let's say they go out and lay off 250,000 government employees. Every one of those government employees has a mortgage. Well, at least a lot of them do. They've got bills to pay. They contribute to the economy. So they have to be reabsorbed and paid by somebody else. Otherwise, you just have massive unemployment. All of these things, regardless of what goes in that direction, will lead to a suppression of a growth-based outlook. So I think it's fairly interesting right now to watch how growth stocks are still going through the roof. Very optimistic, which, as we've discussed, do much better in a low interest rate environment. And by the way, speaking of PEs, Kirk, the PE right now for the NASDAQ 100 is 32.26. So a lot of gross, NASDAQ tends to have a lot of tech and a lot of growth related holdings in it. So while the S&P is at 27.87, which is fairly high, the actual looking at the 10-year on that, we're looking at the 10-year S&P is just over 30. I had it in here. Just a couple. Oh, yeah. The current S&P 500 10-year PE ratio is 36.5, which is 79% above modern era market averages of 20. So, yes, our PE is high, but PE in growth and small caps is even higher. All of the talk is to cut. And if they're going to cut, that's generally not bullish for the outlook of growth-based stocks or the economy. So, very interesting that now there's a lot more positivity, a lot less thinking that we're going to go into recession when anytime you stop paying people and those people stop buying goods and you're raising tariffs, which again do have a trickle down effect. There's arguments on both sides of the fence whether or not that's going to be good. A lot of economists say no. Then you end up in situations where it tends to temper, the economy. But right now, everybody's bullish. So there is some conflicting data in what they're saying they want to do versus what that would act, the way they, people are predicting the outlook to be. When one tends to lead an inverse inverse, at least in the short term, to the other. So wait till January. Things are going to get really interesting. The other thing I wanted to say that I thought was a very good note was a note, and again, I've got to get running here shortly, so I want to make sure I get this in, is that we are, as people who've been listening to the show know, I'm always thinking about the impact on the budgets and cash flow of Americans, especially when we get into looking at the impact of college spending and college debt. And it actually, they just came out with an update that just kind of looked at what the average debt being taken by families in each state. I'll put this up. We can post this another time for the sake of time. But student loan debt rose by $21 billion in Q3 2024 to a record $1.61 trillion. Over the last 15 years, student loan debt has grown by 230%. In other words, each U.S. state holds an average of $229 billion student loan debt. Just curious, where do you think the highest amount of student loan balance per borrower is located in the country?
Massachusetts, Doug?
You're getting very, very close. Politically connected, but not as politically connected as this place.
Minnesota?
No, Washington, D.C., the most politically connected place on the planet. But if you think about all the different schools that are there, they're all extremely old school and extremely expensive schools. Around the D.C. area, though, Maryland and Virginia come in at number 2 and number 4, respectively. As a matter of fact, if you include Georgia, which is interesting because we do a lot of work with Georgia. Georgia has extremely favorable tuition costs. It just tells you who's kind of going to school there and kind of what they're coming in, because a lot of the tuition you can get in Georgia, whether you're in state or out of state, can be extremely low in comparison to other states. But the lowest of those 4 is Virginia at $40,000 in average debt. You were bringing up DC, or I'm sorry, Massachusetts, where you're at. It looks like, and it's always hard to see on these small maps, but it looks like Massachusetts might be at about 36,000. And interestingly enough, whether you look at Minnesota at 34, Maine at 34, California at 38, Alaska at 35, Texas at 33. Interestingly enough, some of the states of the most expensive public institutions, private is, of course, its own pricing. It doesn't matter if you're in a state with higher public institution or a state with lower cost of public institution. Heck, Florida has also some of the least expensive public tuition in the United States. And yet the average debt per borrower in Florida is $39.3 thousand, which is a couple $1,000s higher than Massachusetts, which the average school in Massachusetts, their public tuition there is roughly going to be, 50 to 100% more than the cost of someone going to school in Florida in certain cases. So it really doesn't seem to correlate directly to the cost of schooling in that state as to how much each family per state is having as an average borrowing debt. It's very interesting.
Yeah, no, I appreciate that. You have to send that to me. I'll put it up in the show notes. I did want to share a framework before we run out of time, and I also want to share a chart. So I'm going to share the chart. I'm going to share the chart first because this is basically total return of various assets. And if you look here, it's basically the S&P 500, U.S. aggregate bond index, treasuries, T-bills, and then gold. Well, look which one has produced the best returns. Wow, look, it's gold. Now, you guys all know I love gold, but I want to shoot this as a chart crime because this is starting in December of 99 or January 1st, whatever it was, of 2000, which, of course, was exactly, if not close to, the bottom of gold. I think gold was down a little bit from there like everybody else, but gold went on a massive run for like the next 10 years. Then went sideways for another 10 years. And now it's starting to pop back out. We may see another massive run for 10 years. But the reason I'm pointing out as a chart crime is see what happened with the S&P? Basically went nowhere for 13 years. So I would argue that if you took out that 13-year period and just treated it like a normal bull market like we've had, they would trounce gold. Now, I'm not saying one is better than the other. I'm just saying that when you look at charts like this, you might think, well, obviously gold is a better investment. Okay, well, show me 10 years prior. I can guarantee if you show 10 years prior, the S&P is going to be higher at the end of this. The gold is going to be higher. But we all get baited into this because we see something, a pretty little chart, and say, oh, well, obviously, this is the right answer, is to put all my money in gold. And I'm sure someone is saying that. I'm sure someone is saying that out there and trying to convince you that's the case. Now, I happen to like gold. I happen to invest in gold personally, and I think it's a great asset. But am I investing because it's the best performing asset the last 25 years? No, I'm investing for fundamental reasons, and also it's in a bull market at the moment. But there's other things you can invest in too. You could also invest in the S&P, or you can invest in bonds or whatever. But I think if you get caught into well, look at how it performed, you're going to get taken for a ride. And I think that's the important thing to take away from this, is to really focus on what's, not necessarily the chart crime that somebody's showing you, but actually focusing on the fundamentals and the reasons why you'd invest in things.
Yep. And I want to add this, Kirk, and I hate to interject, but I just saw something today comparing gold with Bitcoin, because again, there's this conversation about stores of value, and they get lumped together a lot as to the gold side versus the Bitcoin or the crypto side. And the argument they were making in that one, well, yes, as phenomenal as Bitcoin has done, gold has been less volatile than Bitcoin, and there is a truth to that. But let's talk about who's happier at this moment. Obviously, neither one of them are upset, but Bitcoin has been, has certainly trounced it in its, upside. I apologize, but I'm going to have to bounce to a meeting. It was a short day with a holiday, but so I'm going to let you finish up here, Kirk. But I did want to say, I hope you had a great Thanksgiving, and for everybody listening as well. And if you want some more information on the college information, I'm going to keep it quick today. mergentcollegeadvisors.com, MERGENT, collegeadvisors.com. Go check that out. Download our free information, or check out our scholarship estimator report.
Well, thanks for coming on, Doug. You can't leave because all the trees are going to die. So
the Buckeye leaves have already fallen off, unfortunately.
Yeah.
So,
all right. Well, thanks for coming on, Doug. I'm going to keep going for a few more minutes, but thanks for showing up, Doug.
Sounds good. Take care.
All right. So, all right. Now getting into the weeds, I want to cover two things, then we're going to hop off here. First thing is to show that the Americans holding record share of assets and equities. Now, I don't know how their math works, but if they're just using these three, or where the rest of the math kind of parses out. But if you're looking here, it looks like approximately 30% combination cash debt and about close to 50% in equity. That leaves 20%. Not sure what that is. But in relative terms, which is how you should be taking this, how much are people's investments actually in equities? Well, it's a historically high amount, only to be rivaled by the late 90s. Debt and cash is low, so just something to think about. So I do want to share this one thing, okay? And then we're going to wrap it up. And it's this. For those of you who, we just got through the election, it was a month ago, so I'm giving people time to mourn before I start talking about this. But I want to use this as an example. So if you were in favor of Harris and not Trump, then you're probably going through a mourning period where you feel like whatever, it didn't work out, or however you're feeling, right? Some people have what we call TDS, Trump derangement syndrome, or what's more accurately called is cognitive dissonance. Now, I'm not using this to talk politics. I'm using it because everybody's talked about it, and it's within the public realm of what people talk about, so you should understand it. Now, some people are still experiencing cognitive dissonance where they don't like Trump. They don't, they're rebelling against. They're going to go pitch a fight and do whatever they're going to do. After every election, we have to move on. We need time to grieve for the fact that our side didn't win, but move on. What tends to happen is sometimes people get caught in a rut. They get caught into this cognitive dissonance moment where they're pissed off that their side didn't win, and they're going to do whatever they can to make sure that the other side, can't enjoy the win. And the same psychological effect happens with investing. So if you invest in a stock, let's say you put a month's worth of work into researching a stock, and you've gone through every little bit of detail, and you're convinced you're 100% right. You invest in this stock and it goes down. In your mind, you're thinking, I put in a lot of work. This is going to work. I'm going to invest more. I'm going to dollar cost average down, and on and on and on it goes. In a sense, that's kind of a form of cognitive dissonance. The stock's price is going down, and you're thinking, well, it's just going to be cheaper. I can just buy more of it. It'll be a better investment. Instead of thinking, well, maybe I missed something. Maybe the market knows more than me. And the fact that I'm losing money right now is probably not a good thing. And so maybe I should cut my losses and revisit it later after the stock maybe finds its footing or whatever needs to happen. Okay. Now, when we when we're bought into, and the reason I'm using politics because the election was recent, but if you think about um, when you vote for something, whether you vote for a candidate, or whether you vote for a stock, or whether you vote for your local professional team, sports team, or your college team, you're quote unquote voting for something. And when you're voting, you're bought in, especially if you bet on that thing, like investing, or if you're betting on a professional or college game, you're bought in, right? You're committed, and your ego won't allow you to be wrong. So when your ego will not allow you to be wrong, it's going to do whatever it can to fight to be right. Which means that even though you're wrong, you're betting on the team. Let's say I'm a Red Sox fan and I bet on the Red Sox and they lost. It's because the ump was terrible. It's because the other team cheated. It's because of this. It's because of that. You can't accept it. You're like, my team's still the best. They should have won. That kind of thing, right? Or like after the election, like, well, this person should have won. I'm just thankful last election wasn't close because it probably would have been ugly if it was. So, but if you looked at 4 years ago when Biden ran against Trump, it was close and it was ugly, or, that's what we saw. So, and people were fighting for it because they're like, well, my team should have won. They were cheated. This happened. And you get bought in and you can't let it go. Your ego won't allow you to be wrong and you won't let it go. Now, right now, the Democrats have to let it go. 4 years ago, the Republicans had to let it go. So I'm just being fair. I know it's more recent wound for the Democrats, but in reality, we all have to learn to do that, right? We have to move on with our lives and, go about our business. When you're doing investing is the same thing, right? You're making a decision. You're voting on a stock when you put money into it, right? If I'm buying whatever ABC stock, it's a hypothetical company, so I don't know what the symbol is for ABC, but it's a hypothetical company, right? You're buying ABC stock, and you want it to go up, and you're committed. So when it goes down, you're like, oh, I can't wait. I'm getting it cheaper. What a great deal. And everything you think is positive. Everything coming out of your mind is positive. This is a great deal. I'm going to buy more. I'm going to tell my friends because they don't even know how cheap it is. This is going to be a great deal. Down and down and down it goes. And now it's worth 50 cents on the dollar from where you invested it. You're like, oh, what a great deal, but I'm out of money. Well, that was a bad investment. Okay. So the problem with cognitive dissonance, or in this case, bias, right? Your recency bias, you can call it, there's a whole bunch of bias that come into this, but you don't need to know what it is because there's multiple. But what you need to know is we all do it. Whether it comes to elections, whether it comes to investing, whether it comes to your sports teams, we all do this. And you need to understand the first step for beating this and not getting succumb to the downside of this is to know what's happening. If you know what's happening, you can make the choice of whether you want to submit to it or not. Now, it might be your local sports team and you don't care because F the other guy. I don't really care. That's fine, right? It's a sports team. Who cares, right? It's just you against them. You're not even playing. You're betting money on it, whatever. I doubt any Red Sox or Patriots fans are betting against the Red Sox or Patriots, but if you're smart, maybe in a game you do that, but whatever. That's neither here nor there. But if you're investing, you got a lot of money on the line and you don't want to make stupid mistakes, right? We do this as a country with elections. We vote on who we think is the best candidate. Sometimes we're right. Sometimes we're wrong. It doesn't matter, but we have to move on when we're done. So when you're investing, it's the same thing. You should invest and then disconnect yourself from that investment. It's hard. And I'll just clearly state it is very hard to do this, but you should try. As if you can do that, it will allow you the opportunity to look. It will allow you to look at it like a third party, like it's not like you're not involved, and you can stand back and say, "Would I invest in this today?" Now, we usually do this in the beginning of the year, or we could do it at the end of the year. Everyone should do this at least quarterly, if not monthly. Is take a look at your portfolio and say, "Would I buy this today?" If the answer is no, sell it. That's it. It's very simple. Trim your portfolio anytime. Look at your portfolio. If there's something in there you would not buy today, sell it. That's it. It's simple. You will get rid of so many headaches and so many problems in your portfolio for stuff that sits there for years and doesn't move or doesn't go anywhere. And if you catch yourself saying, well, eventually it's going to go up, and you don't have a reason for it to go up, sell it. Just move on, put your money somewhere else. So those are the lessons for today, and I use that because they're going to stop talking about the election at some point, and I wanted to use it because it's a good example. Because a lot of us get caught into it. 4 years ago, a lot of people got caught into it because it was close. This time, I haven't heard so much because I think most people are like, yeah, okay, Republicans won, I'm going to get over it. But when it's close, everyone thinks they got robbed and they can't get past it. So I'm just thankful that people are getting past it and we're moving on, and fingers crossed, making progress. We'll see. It's still early. I'm always hopeful for any new administration, Democrat, Republican, whatever. I'm hopeful until they disappoint me, which, like Charlie Brown kicking the football with Lucy holding the football, I'm always optimistic I'm going to kick that football. Everyone, even though Lucy pulls it away every time, I'm still optimistic. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.